Hello guys, welcome to our web page again. Today we will continue to introduce our web page to you, and today's article will be about short and long time of investments. And I hope it will be good for you, and I hope you will like it. If you are ready, we can start.
How to use them. Let's look briefly at the basic terms. Shorts are a strategy of short positions of selling and buying assets on the stock exchange, and longs, respectively, are a strategy of long positions. Their use is based on the concept of volatility. Changes in stock prices, traders make a profit due to market instability. It is also worth remembering about the risks. Hedging is used to prevent losses, actions that protect against situations when the stock price develops in the opposite direction from open positions. Bulls and bears are the basic terms in cryptocurrency. A person who has come to the investment sphere should imagine what it is, because this is practically the first thing he will have to face. Bulls and bears are terms denoting the behavior of stock market players and their strategies. So, a person who plays for an increase, choosing a long opening strategy, is called a bull. And someone who puts the market down and opens shorts is called a bear. The bull operates on the principle of buying cheap assets and selling them when assets grow. They look for an undervalued stock that may grow in the future, based on economic and political prerequisites, and get into a long position, that is, open a long position. When everything goes well and the stock price rises to the maximum point of the exchange rate, the bulls sell the asset, thereby closing the deal. The very difference in price between the one for which the asset was bought and for which the asset was sold will be the profit of the bull. Bears are playing from the opposite, that is, on the fall of the market. Also, based on the situation in the world, business news, they choose those stocks that can fall sharply and strongly. Bears choose a strategy of short positions. This makes it possible to make a quick profit if everything turns out as they plan. They buy back a share for the maximum value. And the lower the price tag per share drops, the more profit market participants receive. It doesn't sound very clear yet, but we'll look at it in more detail and with examples. Based on the brief definitions, we understand that bulls and bears play in the market, adhering to mirror strategies, acting absolutely opposite to each other. Let's take a detailed look at each strategy separately. Long position strategy. How does it work? What are the pros and cons? By choosing a long, you automatically get into a waiting position. You buy an asset and wait for the stock to rise in price. The profit will directly depend on how much the stock will grow. The optimal situation will be an upward price trend. This strategy is very popular with retail investors in the spot market, when an individual buys a share and immediately, at the time of the transaction, receives ownership. The advantage of such a strategy is that losses are minimal. You can buy a cheap stock, and in case of bankruptcy of the company, you will lose only the invested funds and no more. The disadvantage will be that you will have to wait for profit. It often happens that you will have to wait for a very long time, sometimes even for years. Although for some it will partly be a plus. Because in fact it is a bet, which means gambling interest. This strategy of bulls is ideal for beginners in the field of investment because losses will be minimal, but profits can be unlimited. Often people just buy a stock, get into a long position, and for a while forget about the purchased stock, of course, if the financial situation allows you to invest some amount. Without a strong blow to your pocket, using it as passive income. Nowadays, this is available to almost everyone, even people without an economic education. Short position strategy. How does it work? What are the pros and cons? This strategy is suitable for more experienced stock market players who can accurately calculate the situation on the market. It consists in the fact that a trader borrows securities, currency or goods from a broker and sells them. Using the example, it will become more clear. The bear is betting that the stock has reached its maximum and will soon begin to fall. Takes a loan from a broker for a certain number of shares and sells them, receiving money for the sold share. When the share price falls, buys the same number of shares and returns them to the broker. The difference between how much he received for the shares sold at the maximum growth point and how much he had to return to the broker, and will be a profit. The advantage of such a strategy is the speed of making a profit. Consider the disadvantages of short trading. The onset of margin call is when the price per share began to rise, not fall. Thus, it turns out that the trader will owe the broker the difference in the increase in the share price. A broker, in order to protect himself, can forcibly close a position, which means that a person playing in such a position will lose not only the invested funds, but also will have to increase this difference. This is the main difference from long. The bear will not have time to wait for the improvement of its position in the market. Risk of increased losses when a trader borrows a stock from a broker. The broker charges a commission on the asset. If a short position is moved to the next trading day, the commission increases. What to use? Of course, everyone chooses which strategy to choose. Our advice is, if you are a beginner, choose a long strategy. Since short is more risky and you can lose all the money if you do not have the proper knowledge and experience in investing,